U.S. tax rules say a shareholder is taxed on the income of a corporation only when the corporation pays a dividend. This lets a shareholder, including a parent corporation, defer its own U.S. tax on earnings that it will eventually receive as dividends or gains. Before 1962, the big evil multinationals shifted profits to low or no tax foreign subsidiaries, called base companies, and deferred U.S. tax on those profits. They would then loan the money back to the U.S. Transfer pricing enforcement back then was spotty, so they were able to stuff a lot of profits in these tax haven subsidiaries. And they still got the use of the money. All this came to a grinding halt in 1962. Wilbur Mills was chairman of the House Ways and Means Committee that writes tax laws. He and others proposed and got passed a provision called Subpart F. The goal of Subpart F was to limit artificial deferral of profits without interfering with normal international business. It worked well in that regard through 2006, when an additional provision reduced its effectiveness in limiting deferral. Understanding how things used to work is helpful in understanding Subpart F. Before 1962, a U.S. corporation would set up a foreign subsidiary in a tax haven. The subsidiary would make investments, buy and resell goods, perform services, or provide financing to affiliates. The sales, services, and financing usually involved companies in the U.S.-owned group, either as suppliers or customers, or both. Profits would be stuffed into the tax haven subsidiary. Then the subsidiary would loan the funds to other group members. So it was just as if the subsidiary didn't exist from an operational standpoint. The group sometimes put functions and risks in the tax haven subsidiary to make sure there were no transfer pricing adjustments. Ultimately, the sub would declare and pay dividends. For financial reporting purposes, the earnings of the sub were consolidated with the U.S. group. There was not even any accrual of U.S. tax until the dividends happened. Savvy individual investors also put their investments in offshore tax shelter companies and deferred tax indefinitely. All this was perfectly legal and good tax planning, but the effect was to defer billions of dollars of U.S. tax until those dividends happened, hopefully during somebody else's career. Enter Wilbur Mills and Subpart F. Subpart F requires U.S. shareholders of controlled foreign corporations to include in their, that is, the shareholders' income, their share of two things: the subsidiary's Subpart F income and the amount of the subsidiary's earnings that it invested in U.S. property. Subpart F was designed to have limited reach. It aimed only at those base companies organized in low-tax jurisdictions doing things involving related parties. As a result, there are a lot of definitions in Subpart F. It's not designed to cause extra tax, only to accelerate tax on artificially deferred income. There are coordination rules to make sure income is taxed only once. In these videos on Subpart F, we'll go through the definitions and the many exceptions they contain. We'll talk about the limits on Subpart F and the rules coordinating Subpart F inclusions with each other and with dividends. These rules are complex and lengthy, and the videos will be too. I'm going to start by using some of the 4 magic phrases together in a sentence. Subpart F requires a U.S. shareholder of a controlled foreign corporation to include in his, her, or its income, his, her, or its share of Subpart F income, and the CFCs' earnings invested in U.S. property. let's define the first two terms. A U.S. shareholder is any U.S. person who owns 10% or more of the voting power in a controlled foreign corporation. U.S. person includes an individual human being, a corporation or LLC organized under state law, or a U.S. partnership, estate, or trust. We'll talk about how to determine that 10% ownership in a minute. A controlled foreign corporation, or CFC as we'll call it throughout, is a foreign corporation more than 50% owned by either vote or value by U.S. shareholders. This ownership can be direct or indirect. We covered 3 easy examples earlier in the video. The examples are shown here. Subpart F applies only to entities that are treated as corporations for U.S. tax purposes. Many types of foreign entities may elect to be treated as a corporation, a partnership, or as an entity disregarded as separate from their single owner. Some entities are treated per se as corporations. There will be a separate video on entity characterization. I've already posted a video on disregarded entities. Also read the Wikipedia article on the entity classification election. Subpart F only applies to entities organized outside the USA. The ownership tests apply to any interest in the foreign entity that is treated as an equity interest. For U.S. tax purposes, an interest is treated as debt or equity based on all the relevant facts and circumstances, not the form. The courts have looked at 26 or more factors from time to time in determining whether something is debt or equity. A full discussion of characterization as debt or equity is beyond the scope of this video and course. However, I do have a good discussion in my book, Income Tax in the USA. For now, let's assume you know whether something is stock or debt. Subpart F applies only to U.S. persons who own 10% or more of the voting stock of the CFC. This ownership, as well as ownership for the 50% test, is determined with attribution. The normal attribution rules of Section 318 apply, with some modifications. Attribution means ownership by one person is attributed to another person in some cases. Let's go through the attribution rules as they apply for Subpart F. Keep in mind that this attribution is used only for determining whether or not a foreign corporation is a CFC and whether or not a person is a U.S. shareholder. It is not used for changing the portion of income included under the Subpart F rules. First, stock owned by one individual is attributed to another individual if the two people are related in certain ways. An individual is considered as owning stock owned by his or her spouse, parents, children, and grandchildren. Brothers and sisters, aunts and uncles, cousins, or any other generations are not included. However, for Subpart F, this attribution doesn't apply to the extent it would cause a U.S. citizen or resident to be considered to own shares actually owned by a relative who is a non-resident alien. Next, stock owned by a foreign corporation, partnership, estate, or trust is considered to be actually owned by the shareholders, partners, or beneficiaries. This applies regardless of the level of ownership. A partner of a partnership or beneficiary of an estate or trust is considered to own his, her, or its share of the stock owned by the partnership. Special rules apply for trusts. A 10% or more shareholder of a corporation is considered to own his, her, or its share of the shares of the CFC owned by that corporation. If the corporation, partnership, estate, or trust owns more than 50% of the shares of the CFC, then that corporation, partnership, estate, or trust is considered to own all of the CFC. Again, this is solely for determining the 10% and the 50% tests. Similarly, a partnership, estate, or trust is considered to own shares of the foreign corporation that are owned by a partner or beneficiary. Special rules apply for trusts. A corporation is considered to own shares owned by its 10% or more shareholders. However, for attributing ownership to an entity, shares actually owned by a non-resident are not considered. There are limits on reattribution that we won't discuss. Attribution rules are kind of tough going. It sure helps to have a good organization chart so you can track who is considered to own what. Let's look at some more easy examples. Joe, again, is a U.S. citizen. Henri is French and lives in France. Joe owns 48% of A, 8% of B, and 80% of C and D. A owns the other 92% of B. D owns 80% of E, and someone else owns the rest. A, B, C, D, and E are all foreign corporations. Under these facts, A is not a CFC, since Joe only owns 48%. However, B is a CFC, since Joe owns 8% directly and 44% indirectly under the attribution rules. C and D are both CFCs, since Joe owns 80%. Since D owns more than 50% of E, D is considered to own all of E. It controls E due to the 60% ownership. So Joe is considered to own 80% of E, and it is a CFC, even though Joe's actual share is only 48%. Pause the video and consider that chart. It will help you understand the 50% test and the attribution rules. Let's look at another easy example. Anne, Bill, Charlie, Dawn, and Ed each own 9% of FC, a foreign corporation. Frank owns 44%, and Henri owns 20% of the shares. All are Americans except Henri. If none of them are related, then FC is not a CFC. However, if Anne and Frank are married, then FC is a CFC under the attribution rules. Other relations here could also cause FC to be a CFC. So there's a lesson here. Be careful who you marry. Your investment baby could end up being a CFC. Finally, here's an easy one without a chart. 11 unrelated Americans own equal shares of a foreign corporation. Even though it's 100% owned by U.S. persons, it's not a CFC because it has no one who is a 10% or more shareholder. None of the U.S. persons meet the definition of U.S. shareholder. And here's a quiz. The 10% and 50% tests are based on different measures. For the 10% test, we look only to voting stock and voting power. Corporations may have different classes of stock, and the classes may have different voting rights. For instance, Green Limitada may have 10 Class A shares and 1 million Class B shares, and each class gets to elect half the directors. Freddie, an American, owns 2 of the Class A shares, or 10% of the voting power. So Freddie is a U.S. shareholder. If Joe, the American, owns the rest of the Class A shares and 1 of the million Class B shares, then green is a CFC. So Joe or Freddie says, I'll have my attorney own one of those Class A shares. He'll vote however I do, and then green isn't a CFC. Well, Treasury thought of that years ago. The regulations say any arrangement to shift formal voting power away from the United States shareholders of a foreign corporation will not be given effect if in reality voting power is retained, just like Joe or Freddie did. It continues, for example, if there is any agreement, whether express or implied, that any shareholder will not vote his stock or will vote it only in a specified manner, then the nominal ownership of the voting power will be disregarded. The regulations give lots of examples, and one of them is just like Joe. The 50% test is an either-or test. A foreign corporation is a CFC if more than 50% of the vote or more than 50% of the value is owned by U.S. shareholders. Determining value can sometimes be trickier, though, where there are multiple classes of shares or multiple blocks of shares. Value determinations are heavily based on fact. There's not a lot of guidance in regs or cases on how to interpret value for CFC ownership. Presumably, normal valuation rules apply, and that just complicates matters. A foreign corporation is a CFC if it meets the 50% vote or value test on any day, even just one day, during its tax year. It's a CFC for that whole year, not just beginning the day it becomes a CFC. And here's a quiz. Subpart F has two prongs, Subpart F Income and investment in U.S. property. They apply only to U.S. shareholders of a controlled foreign corporation, or CFC. The two prongs apply to a particular shareholder only if that shareholder meets the 10% ownership test that we just discussed on more than 30 days of the CFC's tax year. If so, that shareholder must include in his, her, or its income that shareholder's pro rata share of both the Subpart F income and the CFC's investment in U.S. property. This inclusion happens on the last day of the CFC's tax year. Once there has been a Subpart F inclusion, the CFC must change its tax year for U.S. tax purposes to the same year as the majority of U.S. shareholders. Subpart F income includes foreign base company income that we'll define momentarily, and certain other items shown here but not discussed in this video. The inclusion of these items is limited to net income determined under U.S. tax principles, or taxable income, even though the CFC is not subject to U.S. tax. We'll discuss this as well as the rules related to losses in later videos. A shareholder's pro rata share of these items is determined under the rights granted by the corporation for the shareholder's ultimate participation in profits, such as dividend rights. Each U.S. shareholder must also include in income his, her, or its share of the CFC's investment of its earnings and profits, or E&P, in U.S. property, as limited by the definition we'll discuss. There are coordination rules to prevent the same income from being counted twice under the two prongs, as well as prevent counting E&P again when it is distributed by the CFC as a dividend. The first prong, foreign base company income, includes several types of net profits, as shown here. We'll discuss the definitions of the first three in later videos. We'll also discuss exceptions to those definitions. There's one key overall exception designed to keep Subpart F from being a huge mechanical burden for small amounts, a de minimis rule. Under this rule, the first prong, or foreign base company income, does not apply if the Subpart F gross income is less than both of two amounts, 5% of gross income and $1 million. A quick detour is in order here. Gross income for U.S. tax purposes means sales plus other income less cost of goods sold. It's not gross receipts. Further, expense items other than cost of goods sold are deductions, not reductions of gross income. For a U.S. corporation, gross income is reported on line 11 of the Form 1120. So to repeat, this de minimis rule does not apply if the foreign base company gross income exceeds 5% of all gross income. It does not apply if foreign base company income exceeds $1 million. If the de minimis rule applies, though, then none of the gross income for the year is treated as Subpart F income. The rule is all or nothing, not partial reduction. At this point, to avoid confusion, let me clarify how I'm using a couple of terms. The term for what a shareholder includes in his, her, or its income is a Subpart F inclusion, not Subpart F income. The term Subpart F income refers to foreign base company income plus the other items like insurance income that were shown on an earlier slide. In addition to the de minimis rule, there's a full inclusion rule. If more than 70% of the CFC's gross income for the tax year is Subpart F income, then all of its gross income is considered to be Subpart F income. This rule is also based on gross income, not net profits. Another quick detour is in order. Subpart F inclusions are not dividends. They are other ordinary income. None of the favorable things related to dividends apply. We'll talk more about this later. First, though, let's cover another definition. Foreign base company income includes several types of income, and we'll cover in detail what these are. There is one thing in common among all the types of foreign base company income. They all involve a related party at some point, or are investment income. Related person is a defined term under the same section that defines foreign base company income. A person is a related person with respect to a CFC if that person is any corporation, individual, partnership, trust, or estate which controls or is controlled by the CFC or is controlled by the same person or persons who control the CFC. Control of a corporation for this purpose means owning, directly or indirectly, stock with more than 50% of the total voting power of all stock of such corporation. Control for other entities, such as partnerships, means ownership of more than 50% of the beneficial interests. The attribution rules we discussed a while ago apply. A person is a related person whether or not that person is a U.S. person. Here are two examples. Joe owns 80% of C, a CFC. Joe is a related person for C. C also owns 51% of D, the other 49% of which is owned by Helga, a Norwegian. While D is not a CFC, it is a related person for C. Joe also owns 80% of U.S. corporation J Inc. J Inc. is a related person for both C and D. In the next 3 parts of these Subpart F videos, we'll discuss the rules for determining Subpart F income. Keep in mind this related party definition. It will be critical in such determinations.